We've got Bobby Giacchino, experienced futures trader. You may have seen him. He has a lot of stuff online with the podcast that he does with my good friend Jim Urio. You know, how do you start your day, and what do you think about these as an instrument, because you've been active in this for a long time?
Yeah, I've been doing this for about, I think it's 32 years right now. I know I look great, but I'm older than I look. It's one of those things where early in my career, the first thing I looked at was the top 4 indices in the US in futures. I would look at the Dow, the S&P, the Russell, and the NASDAQ futures overnight. Because the liquidity in the futures has been great 24 hours a day before anything else went 24 hours a day. So that, to me, was one of the best indicators. It's still at the top of my watch list. It's the first thing I looked at. When you have big moves overnight in Japan, it affects the US. When you have big things happening in the EU, it affects the US. The macroeconomic outlook is shown to you first in the equity indexes on the futures side. It's where the biggest traders in the world go. Any of you ever heard of Monroe Trout? Stan Druckenmiller? Paul Tudor Jones? I know Monroe Trout because a friend of mine that I went to high school with, he's in Market Wizards if you haven't read that yet. He was one of his CFAs that was in Bermuda with him. And I met him once when I went to visit him in Bermuda, and he said to me, "What do you trade?" I said, "Futures." He goes, "That's what the real traders trade." Now, I'm not saying that those of you that have not traded futures are not real traders. Far from it. But when you get involved in futures and you understand the minuscule amount of capital that you can use to trade a lot of the same things that you're trading in stocks, you almost think at your past life as a trader as having been not used in its best way, right? You can impart your opinion in markets based on some of the macros that you just mentioned, whether it's unemployment, whether it's the EIA report with crude oil. A lot of people, I used to watch you guys on CNBC, and the moderator would always say, "So crude oil's going up, what names are you looking at?" And I'd be screaming at the TV, "Why aren't you guys looking at crude oil? Why are you looking at crude oil companies where there could be a CFO scandal that can affect Exxon or affect Valero? Where crude oil is moving, it's crude oil that's moving." So it's where the actual market shows its opinion of the macroeconomic events first.
And sometimes, actually, the futures market is telling you what's going on in the equity markets first as well. How many of you have looked at CNBC or Bloomberg, and in the market's not open yet, and you see something called fair value? And you're wondering, and I've had experienced investors come to me and like, "I don't understand what fair value is." So before we kick it over to Carly, maybe you could just quickly explain to them what it is you're looking at when you turn on your screens, you turn on the news before the equity markets are open, the futures markets are ticking.
It's basically the way that CNBC and others digested it for people who don't trade futures. They look at the futures market, calculate where the cash will open, and they call that fair value. The exact calculation to me is not interesting. But the fact that they're doing it off the futures market to make it, you know, discernible for the average equity trader, that's what they're doing.
In other words, futures are telling you what the price is before the equity markets can tell you themselves because they weren't open yet.
So essentially, these products are open around the clock from Sunday evening until Friday afternoon.
Which is really convenient if you have an active futures trader like Bobby who couldn't wait until he got up on the stage to effect a long position in gold, which he did. And I think since they didn't get to walk through it when you did this,
we still can.
Could you please just show them how you came to that conclusion?
So I'm going to have to walk through it. So which one's the 30-minute?
30 minutes is
up
on
here?
the left. It's on the left side over there.
That's right.
Your left.
All right. By the way, 2 funny things just happened. Number 1, Craig said Chicago time. I lived in Chicago most of my life. We say Chicago instead of Central. I always found that funny.
Bobby.
Well, no,
the other thing I didn't mention was the tick, and I'm sure you're going to get into that.
Yeah, I'll get into that. But we, I live in Florida now, so I say Eastern time or Chicago time. I don't know why we've always done that. So the 30-minute chart actually has a small double top on it, okay? If we get a close, I can't see what that center low is. It's basically right below the digit on the $21. No, this way. I wish I had a pointer.
Right here, Bob?
This one right, you can't see me.
Jump.
Okay. Go to the right. Dude, I'll tear my Achilles if I jump. It's in the very, very recent, let me come over there, because this is actually important.
Which level are you referring
It's on the 30-minute chart.
Yep.
Right over here.
Oh, this right here?
Yeah, that low.
Okay.
So that gives you a small double top on the 30-minute chart. Okay, so why'd I buy it? The double top is confirmed by the red wick just to the right of it. That confirms the double top in the way that we view double tops. But it didn't trigger it. So what happens a lot of the time with these particular patterns is they pressure to the upside. What are technical patterns? They're just the mob telling you what they're seeing and what they're going to do next, right? Carly is one of the best technical analysts, to me, on the planet. She understands that what's behind her charts is what all you guys are doing. I know guys personally who, when I've gone on CNBC, and they tell, what's the technical showing? And the guy's name is Scott Nations. I love him. He's a great human being. But I remember one time I was looking at a chart, and I go, oh, the trend's here, and the fibs say this. And he goes, oh, that just looks like a lot of lines and squiggles to me. What technical analysis does, and I was in the presentation yesterday where only about half of the people in the keynote stood up that they had ever done any sort of price action or technical analysis. You should learn it, because it's really what the mob is doing. When I first started trading, I lost $97,000 inside of 9 months. That was with my first wife. She's not married to me anymore. I'm sure that's part of the reason. But that's because I was right and the market was wrong, which we all know is not true, right? So this particular pattern, if it doesn't trigger the double bottom, it gives me a quick short-term profit on the upside. So it's literally like a 50-50 trade for me.
And then, Bobby, I'm curious if you have any thoughts on where you'd like to limit your risk if you think this goes wrong, or where you're looking to actually get out, and we could put some other limit or stop orders in as well.
So again, that particular level, and I want to make sure that we're highlighting it. Can you widen that out?
Yeah. And if you want, I could actually even put like a little trend line here.
Right below that low.
Right here?
Yeah.
All right.
No, the other one.
This one right here?
The higher low, yeah. Right below that one will be a stop and reverse for me.
Okay, so that would be...
So we need to close below it on a 30-minute chart.
So that would be about, what, 36.8240?
Yeah, and we're going to get out of this one quickly. Craig mentioned delivery, and I think one of the things that scares people out of even looking at futures is the possibility of delivery. I trade about 60% futures. It used to be 100% futures. Okay, I grew up in the pits of Chicago. I used to trade 100% futures. My average hold time across my accounts is 26 days, okay? That includes all my futures. I think I've had to deal with delivery becoming a problem for me as to whether I wanted to deliver or roll into the next contract probably 10 times in 30 years. It doesn't come up that much for active traders. It really doesn't. And when you're with a reputable broker like RobinHood and you're trading futures, they let you know the problem is coming, that you either need to roll or you need to exit or, don't ever do the delivery process. Well, I mean, if we buy 1 micro gold, right, future, you're talking about, what, 1650 you said was the margin right now? The equivalent in like an ETF is about $33,000. Now, even if your Reg T margin, what is that, 50%?
Reg T is going to be 50%.
Okay, you're talking about
when you initiate.
$16,000, $17,000 that you have to place down. So it absorbs money that you guys want to use to trade stocks when you're interested in the stock. So it's, to me, I think that's why Monroe Trout said to me what he said, that real traders trade futures, because you can take advantage of your capital. Now, I have to stress.
Well, with stocks, it's also fully paid. You're borrowing a portion of the capital.
You're borrowing
using margin, so that's an important consideration as well.
I know I'm talking a lot. I apologize for that. I'm Italian. I'm moving my hands. I'm talking a lot. The other thing about it, and we can get out of this if you want.
No, what I was going to say is, if we want, I want to just show them where you're actually looking to,
Yeah, this was a scalp for me, so the target is was about 36.8880, so I would have gone 36.88. It's just a scalp. So what I'm trying to do is take advantage of the double top. You can see in the middle of your chart on the screen there, the double bottom that worked out really well on that same chart to the left of that. Right, you can see the two bottoms. Looks like they were on about September 9th. Yeah, both of them were on about September 9th. You could see a double bottom there. Double tops and double bottoms are reversal patterns.
What would you like to take a look at, Bobby?
Let's do the micro S&P.
Sounds good. Yeah, we're going to pull up the /MES contract, which is the micro S&P 500. each point is going to be worth $5.
First of all, I want to say that, so the woman over here was kind enough to ask a question. I hope we get more of them. I don't consider myself a day trader. I don't consider myself a scalper. As I mentioned, my average hold time is 26 days, which a lot of people would call me a swing trader. I hate all of those terms. I have held futures trades for 6 minutes. I've held them for 6 months. It all just, to me, depends on stop, target, and the risk. One of the great things about these micro contracts is I was talking to Craig earlier this morning. I was talking about the difference of buying 10 micro gold versus buying, Barrick gold or even GLD. And he said, well, why are you buying 10 micros instead of one big one? And I said, well, because I want to be able to get out one contract at a time, right? And I'll be able to scale in, scale out, and that kind of a thing. When I look at this S&P, and I use a derivative of Bollinger Bands. Everything's basically a derivative of Bollinger. What a smart guy. I use something called percentage B, and I'm waiting on a percentage B on a shorter term chart to give me a buy signal, and I haven't gotten one yet. You mentioned stocks. This is one of the things I enjoy about futures, is because of the micros, I can shrink my positions down so small. I owned Chewy, and yesterday I was in profit. And this morning, I woke up, and I wasn't anymore, right, because of the earnings. So we talk a lot about risk with the macro picture. Macro for stocks is obviously earnings for the most part, right? Macro for the S&P is back to the economic news. So I got hurt on Chewy while the S&P was positive and still is. So I personally prefer to put the vast majority of the trades I think are going to be shorter term into the larger indices on the future side, so that I don't have to put up so much money up in the Qs or the SPY or anything else you guys want to trade. So for this particular contract, I keep waiting for a short signal, and I'm not getting it because of what Carly said. The larger picture for me in equities is to the long side. So I don't have a micro S&P trade to show you guys. But what I will say is that if you're looking for shorter term trades, the micro S&P and the micro NASDAQ, where I might actually have a trade, should have said that first, is probably a better look. When you look at the volatility involved in these, over these economic events like PPI, like CPI, we keep waiting for that tariff inflation. We keep hearing about that tariff inflation that's going to come down the pike. Mike Lee, who's a pretty smart guy, he posted on X this morning, maybe next month we'll get that tariff inflation. But right now, with the structure of the macroeconomics that we're looking at a Fed that's either going to ease a little or ease a lot, depending on what the macro data shows. And the S&P, I think, is the best place where that's going to play out. We have a really strong breakout level. You can kind of see it. I don't even need to show you where it is on this chart. The S&P broke out and now is going back, trying to test that larger breakout level. That's where I'd like to, right about there. That's where I'd like to buy it if we get down there. I don't know if we'll get down there during this session.
So, Bob, you're talking right around
what price is that?
65.20?
Yeah, about 65.20. Scaling in for me was something I started doing because of my FOMO. Like I would see a trade, but I would know I needed to buy it lower. So then I would get in early, and then I'd be mad because I put on my full risk. So scaling in was something that allowed me to get into trades. And then it's like, all right, I wish I put on the full amount, but I didn't. That's okay. I still made something.
If you wanted to, let's say, hold it for longer, I know some of you mentioned holding it for months. So does that give an advantage since you don't have to roll your contracts?
Personally, I would always roll rather than do that. The further out month contracts, crude oil is the thing I trade more than anything, right? And the further out contracts, specifically in crude oil, can sometimes give you a hint on how your near-term trade is going to do in the future. But I personally roll because the further out contracts are much more often hedging vehicles, and they don't have the liquidity, at least in my experience.
Yes.